This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I know you're excited to get into today's show, but I have a very exciting announcement to share with you before moving to the show. We've just launched a complimentary and comprehensive webinar that, among other things, shows you how to legally use passive real estate investing to reduce your taxes, recession-proof your nest egg, and take the sting out of inflation. If you are curious to learn more, go to stevetalker.com/webinar. It is complimentary and only takes a couple of minutes of your time. Once again, that is stevetalker.com/webinar. I'll see you in the webinar. Enjoy today's show. Hello, enlightened investors. Welcome back to Real Estate Investing Abundance. I'm your host, Dr. Allen, and what a pleasure to have you back with us today. And we have a treasure trove of information for you today from a very well-experienced investor and capital raiser, and he's done all kinds of things. So with us today, our distinguished guest is Dr. Adam Gower, and he is going to help us to figure out how we can survive, thrive, and come out on top investing in distressed real estate. So Dr. Gower is the country's foremost expert on commercial real estate, online syndication, aka crowdfunding. He is a multi-book author. His clients handle in excess of 35 billion in assets under management and have raised over 1 billion in equity. He is currently focused on bringing discounted, distressed opportunities to his accredited investors. So welcome, Adam. And just start us out by sharing your background with us.
I'm so glad that you asked me that. But you know what? I have to ask you. I've got to ask you a question before you even start. And just forgive me for doing that. I didn't know you were a doctor. What are you a doctor in?
I am a doctor of philosophy in organizational systems psychology.
Oh my goodness! Wow, that sounds like you actually had to do some work to get that PhD.
Well, yeah, PhDs don't come easy, but yeah, a lot of research involved.
All right, good. Well, mine actually is in a small window of banking history. I looked at
wow,
banking risk mitigation during the early 1900s, but it's a long story, and but it does actually have direct relevance to what we're going to talk about today. So thank you for asking me anyway.
Well, yes, history, as they say, if we don't know our history, we will repeat it, and we may even if we know it. So
yes, well, the problem is that if you do know history, we're doomed to watch other people who don't repeating it. That's
this is true. Yes.
All right. So my background, apart from the PhD, to answer your question straight up. All right. So let's talk about commercial real estate. Actually, I'm going to try and keep this brief because you have picked my favorite topic, which is to talk about me. And I can talk for hours and hours about that. So I'll try and keep my background brief. But I started actually in commercial real estate pulling wires for an electrician in 1982. I even hate to admit that because it makes me sound really old. And very rapidly went on to raising capital for multifamily ground-up developers in Southern California. Then there was the savings and loan crisis, which eviscerated the industry and all the money, including mine, that I thought I'd made at the time. So I went from being a multi-millionaire on paper as a young man to having nothing overnight. I ended up in Japan helping investors with their workouts and divestments. I'd raised a lot of money. And I ended up working for a joint venture of Universal Studios and Paramount Studios, building all their real estate in Asia Pacific. I was Daihyo Torishimari Shacho, which means president of the division in Asia Pacific for the studios during the 90s. Then I came back, started doing my own developments, and had the, I don't know, I mean, I would like to say it was the foresight to sell everything in 2007. But between you, me, all your millions of listeners and the NSA or wherever else are listening, the truth is I just had dumb luck. And And there was something going on in the market. I didn't know what it was, and I got nervous, so I sold out. I was then brought into East West Bank, one of the biggest regional banks in California, to help them with loan divestments. They had done a lot of real estate collateralized lending in the run-up to the global financial crisis, and my job was to come in and help them clean the balance sheet. I ended up moving on to, I'm cutting out a few things, but I ended up going over to running a fund, $200 million fund for Hong Kong Chinese investor, and then worked at Colony Capital, the late Colony Capital, who had purchased around $7 billion of non-performing loans from distressed banks in partnership actually with the FDIC. So I did very well actually during the last downturn with working on workouts and seeing just about absolutely every way that real estate can go wrong. So it was my second major downturn. The first one, I lost everything. The second one, I didn't, and did fairly well. But I did learn what can go wrong. And I saw every possible asset class across the country and how borrowers behave and how banks act and etc. So it was a learning experience. Once the market started to pull around 2012, I started doing seed and angel investing. And that was where I learned the language of digital marketing. All of these little startups, right? These 20-something-year-old kids, I don't mean to be patronizing, but a lot younger than me, were talking a different language. And it was the language of digital marketing. So when the Jobs Act of 2012 passed, that allowed real estate sponsors to raise capital online, in other words, engage in digital marketing, I saw an overlap between these new regulations and what I'd been learning in seed and angel investing, the language of digital marketing. So I started Gower Crowd, and really actually started with a podcast and built websites and started building funnels and really hands-on, did everything myself. Took me years to figure it out and to really dial it in. And my first book on the industry was called Leaders of the Crowd. It was published by Palgrave Macmillan. And I interviewed people from the White House and in Congress and lobbyists and early movers in real estate, what's colloquially called real estate crowdfunding. And started to track what was going on in the industry. Who were the leaders? What were they doing? What were they doing successfully? And how were they doing it? And then started to build systems that were best of class, picking the best of class practices across the industry and applying those to our clients who wanted to raise capital online. And that's what I've been doing since then. Is building essentially crowdfunding platforms for sponsors so they can find accredited investors, nurture them, and convert them into being active repeat investors in their deals.
Well, as I said, starting out, you had a very wide and deep and diverse background there, and you certainly have. Well, even though digital marketing and crowdfunding for real estate have been around since 2012, which is almost a decade now, there still is, I think, a tremendous amount of misunderstanding in terms of what that is and how it works, and even a lot of questions in investors' minds as to whether or not they even want to be involved in that. So give us a little bit of background in what it is and how it works when it works like it's supposed to work.
Right. So it's a good question. It is still blue ocean opportunity for sponsors to be raising capital online. The industry has grown dramatically over the last 10 years. In fact, it's not really 10 years because the laws weren't promulgated until 2014. And then it took a long time before it really started to take hold. But we've been tracking the industry. We scrape the SEC database. We analyze what's going on. And crowdfunding or raising capital online has become a dominant force in capital formation for sponsors in that period of time. So there are two ways to look at it, and I'm going to just jot some notes down so I don't forget what I want to say. So the first one is, look, if you are still raising money through in-person meetings, right? By calling your financial advisor or your attorney or your accountant for introductions, or going to conferences and meeting people individually, and then going ahead and trying to raise money that way, it's completely legitimate. It's how it was done since 1933. Securities Act made it kind of mandatory to do it that way, in person. I won't get into the technicalities of why, but that's how it was always done historically. But it is an incredibly time-consuming and inefficient way of doing it. Why? Because every time you meet somebody, you have to go through the same exact process repeatedly. You've got to tell them your background, your track record, your investment philosophy, your investment thesis, and you have a series of meetings and a series of follow-ups, and it's just a very labored process. So by taking your efforts online, you are able to leverage your time dramatically. Essentially, at a high level, what you're doing, Alan, is you're basically taking your entire story and digitizing it, which all that means is you're just writing articles and creating videos and putting posts on social media that explain your story. Now, the advantage of that, one, is that, first of all, you can be seen everywhere by everyone all the time. So that has the effect of attracting people to you. You don't have to go out and find them. They will find you and come to you. The second thing is that you are no longer doing in-person meetings. So you don't need to be explaining yourself again and again and again and saying the same thing again and again and again. And more importantly, as charming a fellow as you may be, right? Right, you and everybody else, nobody wants to sit down and be pitched, right? So if you invite somebody to say, listen, I heard I got an introduction from my accountant. Would you like to get lunch? And I'll tell you all about, what we're doing. Whoever that prospect is thinking, oh my goodness, all right, I got free lunch, but now I got to sit and listen to this guy pitching me for an hour or two. Nobody wants to do that. So you are not only leveraging your own time by putting your story up online effectively, but you're also facilitating your prospects in their research of you. It's one of the big advantages of, and I'm going to use this term colloquially, crowdfunding. Really, it's just online syndication or digitizing your story. But one of the big advantages is that your prospects are able to research you and decide whether or not they want to know anything more about you anonymously. That's what we all want to do when you buy a car. You don't want to go in and be sold a car. You don't call the manufacturer to find out, you do research online first. You decide how you're going to act, what you're going to invest in, what you're going to buy, and then you act. So for sponsors, you want to make that process of doing research on you as easy as humanly possible for your prospects. Make it easy because they're going to research you anyway. So just make it easy for them. And when you do it online, you're making it easy for everybody to do that. That's the beauty of it. Now, the second thing is, and the word that I've written down here is invisible. If you don't do that, you are effectively, in a digital age, you are invisible. If somebody runs a search, let's say somebody's interested in investing in commercial real estate as a limited partner, and they run a search on you online, or let's just say they run how do I invest in commercial real estate? If you don't have a solid online presence, you will not show up. Who's going to show up? Our clients. In all likelihood, those are the people that are going to show up. And so those are the people that your prospects are going to go to. Let's say, for example, let's just take this one step further. Let's say you do have an in-person meeting and you talk to a high net worth investor or prospect over lunch, and you talk about the internal rate of return, the IRR. right? And you just casually mention that, oh, yes, we have a historical record of 22% IRR, and then you keep on going. Well, what are they going to do afterwards? They're going to go home or back to their office. They're going to run a search online. They're going to say, all right, what is the IRR? They're going to say capital stack. What's the capital stack? If they do that and you don't show up, what's going to happen in those searches? Or if they go to your website, that question isn't answered. What's going to happen is somebody else's website will show up. They will learn from that person and probably end up investing with that person instead. You will have lost that opportunity because you are invisible online. So those are the two key reasons why you want to have a good online presence.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Well, thank you for that explanation. It makes much more sense to me when we're talking about it in really concrete terms like that, instead of these, what are really for me pretty esoteric terms of crowdfunding. So that explains really that digital presence. So talk to us about what is crowdfunding as opposed to just a digital presence.
Okay, so crowdfunding is, technically speaking, really all, and I don't want to get into the regulations or like too much detail about the regs that, you know, were involved in the Jobs Act, but crowdfunding effectively is a legal term that relates to the idea that as a sponsor, you are allowed, since the Jobs Act 2012, to solicit. This is a Securities SEC regulation, Securities and Exchange Commission SEC regulation, that you are allowed to solicit people to invest with you who you don't know. In other words, you can advertise. You can say, hey, come and invest with me. Now, keep in mind that when you are asking somebody to invest in any of your deals, what you're actually doing is you are soliciting them to buy securities. Why? Because what you're doing is you're setting up an SPV, a single purpose entity or single purpose vehicle, whatever you want to call it. That's a company. And when you raise money, you are selling shares in that company. That's an SEC, that is securities law. So crowdfunding is the Jobs Act allowed you to now solicit directly from anybody to sell those securities. Prior to the Jobs Act, you weren't allowed to do that. You couldn't sell securities without doing an IPO at a high level. You had to do an IPO. And who's going to do it? If you got a $10 million, $20 million deal, you're not going to do an IPO. Facebook does IPOs, right? But sponsors don't do IPOs. So the Jobs Act allows you to now to do general solicitation, to solicit investments from people you don't know, right? That was a fundamental shift in the regulations. Now, that's great. So now you can solicit from anybody that you like. That's crowdfunding. But how do you do that, right? How do you do that? Well, the mechanism for doing that is by having an online presence. You've got to have a digital footprint, an effective digital footprint, in order to be able to solicit from people you don't know. You could, if you wanted to, you could advertise on you could buy a 30-second slot. I don't know how much they charge these days for $5 million during the Super Bowl. You can totally do that. You weren't allowed to do that until the Jobs Act, but now you can do that. So in theory, that is what you could do. You could just advertise. You could fly a plane over the city and say, invest with me, call this number, right? That was not allowed. Mm-hmm. So in order to be effective in taking advantage of now this regulation that allows you to solicit from anybody to sell your securities, you've got to have a digital presence to do it effectively. Mm-hmm. So that's the distinction. One is the regulations and the ability to be able to ask anybody, even people you don't know or that don't come through an introduction. That's the regulation. But the mechanism for doing that is to advertise, and that means to have a good, solid online presence.
Well, correct me if I'm wrong here, but there is the regulations. There's the 506B and the 506C. And while we can advertise ourselves in general, that we have investment opportunities under the 506B, we cannot specifically advertise the particular deal. Is that correct? Whereas
Correct,
under
yeah.
the C, we can advertise the
Yes.
deal.
So just to make it clear, I'm not a lawyer. However, I do know this area very well. Please seek advice from it. The rule that I like to tell people, both in terms of legal advice and any kind of tax, is the AAA rule, the AAA rule. Ask an attorney or ask an accountant, right? So that's my CYA, if you pardon the expression. But you're quite right. Basically, a 506B does not allow for general solicitation. You have to have and be able to demonstrate a pre-existing relationship with anybody you invite to invest with you. With a 506C, you can ask anybody. You can put an ad up on the Super Bowl. You can have it on your website. You can advertise on Facebook. Hey, invest with me. These are our projected returns. You can do that with a 506C. You cannot do that with a 506B.
Well, thanks for clarifying that. What are we talking about in terms of distressed real estate? That's your focus these days. I don't know if it has always been, but now you're focusing upon distressed properties. So what is a distressed property by your definition, and how is it that we can invest in distressed properties to make money?
Okay, so I'm so glad you asked that question. So the concept of distressed real estate, I'm going to use maybe a slightly glib overstatement, but I will provide a proviso as well. There is no such thing as distressed real estate. Now, the exception to the concept of distressed real estate might be something like toxic waste, right? If suddenly if you discover that there was a dry cleaners on your site 100 years ago pumping whatever into the ground. Okay, now the real estate itself is distressed. There are significant problems with the real estate itself. But even some people would even see that as an opportunity. But that's kind of what distressed real estate is. Distressed real estate is really just the way that the capital stack is structured. It's the way that the real estate is financed that creates the distress. So, for example, if you take out a loan of, let's just pick a smallish number, but let's say you got a $10 million loan on an asset that you've bought, and now that loan is worth, and you borrowed and you raised 5 million. So you bought it for 15, you borrowed 10, and you raised 5 million in equity, and now the value of that property is 7 million. That is a distressed real estate deal, because now the capital stack that is sitting on top of the real estate, or that has financed it, is no longer tenable. So that's what makes it distressed, is the way that it's financed.
So from this definition, it could be an A, B, or a C, or even a D property. It has nothing to do with the class or the condition of the property. It's what we're talking about here is that capital stack.
Yes, exactly. It could be any kind of asset, any A, B, C, D class across any asset class, office and industrial, retail, multifamily, it doesn't matter. That's exactly right. It's the capital stack that matters. That is what drives the distress.
Well, how can we, as investors, how can we benefit from these distressed properties? And I guess the first thing would be, how do we go about finding these distressed properties?
Okay, so now there is another aspect to distress. So what's going to happen, and what you will see happen typically with an asset that is under financial stress, right? That has a capital stack that is underwater. Is that sponsors will often start to neglect a property. So they will, you'll see increased deferred maintenance, or increased maintenance, or deferred maintenance. You might see increased vacancies. there are other aspects that can reduce the value of an asset that are physical or economic, that are separate from the capital stack itself. So typically what will happen when an asset does fall in underwater in terms of its capital stack is it will start to suffer other kinds of stresses, right, that make it even more distressed. There are all kinds of ways of finding. Now, okay, so what happens during a down cycle is that there is a period of wealth transfer. So people whose capital stacks end up underwater, sorry about that, this is the work from home thing going on. But people that have that find that their capital stacks are underwater, there are various ways that you could. That's what are likely to lose those properties in one way or another, right? And their investors will lose their capital, they'll lose their capital, and the property will transfer to somebody else. And there are various ways that that will happen. One area that I'm most familiar with is banking, having done a lot of work in banks on non-performing loan portfolios. So in those cases, what will happen is the bank will sell the loan itself, not the property. They will sell the loan to a buyer who steps in as the lender. And that buyer will look to, in many cases, and again, there are many layers to this, Alan. So, I'll just give very high level overview of what happens. But that person will typically want to get access to the property. So let's say a sponsor owes 10 million, is now in default on the loan, owes deferred interest, penalties, fees, etc. And the buyer of the loan maybe paid a discount to the bank. So instead of paying 10 million, maybe they paid the bank 8 million for that loan. But what the buyer wants is they want to get access to the real estate. They want to own the real estate. There are exceptions, right? If the borrower pays them off, that could be a win if they bought it at a discount. But just using this example, you want to get to the real estate. So now this new lender, right, the buyer of the loan, steps in and negotiates with the seller for various outcomes. They could get a deed in lieu of foreclosure. They might press on personal guarantees. You might trigger bad boy carve-outs that put pressure on a borrower, but they will seek ways to gain access to the property to encourage the borrower to hand over the keys to the real estate, right? So option, that's where you might buy a loan from a bank in order to get access to the real estate. Another way that you can invest in distressed real estate is what's called rescue capital. So rescue capital, and that can be in multiple different forms. That could be preferred equity, it could be mezz debt. There's all kinds of ways that can be structured. But that's where, again, taking our example of the borrower who bought a $10 million property. And some example, actually, it's not a good example because in some cases, even rescue capital can't help. But we've got for example, we have a deal on the table at the moment where we have a developer their costs of development have gone up by $1.5 million, some a ground up multifamily, fully entitled multifamily deal. So now they need another $1.5 million of equity. So a rescue capital investor might say to them, okay, good. So you've got, again, I don't know I do know, but I'm going to give all the exact details. I don't want to be indiscreet. But you might have somebody come in and say, all right, we'll bring you that $1.5 million of capital. However, we want 90% of the promote. So we're going to save your deal by giving you the extra capital that you need to avoid foreclosure from the bank, to avoid losing the deal to the bank. But in return for this capital, we want 90% of the promote. We want your fees to be lower, and we want a vast majority share of any profit you are hoping to get. So that's not typically, but that's kind of how rescue capital might work. And that's another way that individual investors can invest in distress, is to invest in rescue capital, in pref equity or mezz debt, for example. So those are two examples of ways that you can invest in distress deals.
Well, Adam, we are running out of time here and we're getting into some complexities. So I suspect that in one of your more recent books, you talk about these things. Is that correct?
Yes, Alan, thank you for asking me about this. Very kind of you. So I just wrote a book called The Reality of Distressed Real Estate. Basically, that's the name, Reality. It's only $7, and if you buy it and you don't like it, let me know. I'll give you $7 back. And you can there's a link on my homepage at gowercrowd.com where you can learn more about that book. But I do get into it in detail. I look at the economics of distressed deals, and I also discuss multiple other ways that you can find access to discounted distressed deals. Yeah.
Sounds like a worthwhile book to have in our libraries. Well, Adam, what are some other ways we can get in touch with you?
Thank you. Yes. So really the best way is to go to gowercrowd.com, right? It's my last name, GOWER crowd.com, and sign up for my newsletter. It's free. It goes out every Wednesday. And we cover all aspects of real estate syndication, crowdfunding. And at the moment, we have a focus on distressed deals and how to access them. But that's all at gowercrowd.com. And there's a subscribe button somewhere, hopefully in bright red or some other obvious color at the top of the page.
Well, Dr. Gower, it has been a delight having you, and thank you for enlightening us. It's been very informative for me. So thank you so much.
Dr. Allen, thank you very much for having me.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.